Hi everyone, it's Kaylee here. Thanks for having me on today. I'm really excited to talk about a topic that comes up all the time in our life. Risk in complex lending. Whether you are working with self-employed clients, investment buyers, or clients with multiple entities, understanding and explaining risk clearly is what sets us apart as brokers. So let's go through some of the common situations where risks show up and how we can manage it properly. So the first one, interdependence in self-employed lending. When you are working with self-employed clients, especially if there are two borrowers or guarantors involved, it's really important to look at the full picture. One person might be running a profitable business while the other is reporting losses. If these businesses are connected or rely on each other, that creates a risk. If one of them fails or the cash flow drops off, the whole structure can be affected. This is why I always take the time to explain how the income flows and what will happen if things changes. So lenders want to see the income is consistent and reliable, not just in a good month. And the second one is economic changes and the impact on income and as asset. So the broader economy has a huge impact on lending risk. So interest rate risk increase, inflation or shift in the housing market can be affected clients or affect clients' income or the value of their asset. For example, building costs might go up or property values might drop, and that affect equity and borrowing power. For self-employed customer, a slow market might reduce turnover. So when I'm working on a deal, I always think about what the situation may look like in a year or 5 years from now. I make sure to note that in my comment to the lender so they can see what we've thought about through. So the third one, credit reporting in complex deal. So credit reporting has become much more detailed now, and that really helps in complex lending. It's not only just about default anymore. We can now see the repayment history, current limit, and even whether someone had a financial hardship. That gives us more to work with when presenting a file. And it helps us to confirm the full picture. If a client forgets to mention a loan or credit card, the credit report will just pick it up. And it's also a good tool to reassure the lender that the customer is managing their debt pretty well, especially when their income structure is a bit more complex. So the fourth is product risk and penalty costs. Some loan products carry more risk than others. You might have a fixed rate loan that looks great on paper, but it has high break costs if the customer wants you exit earlier. Or the term may include a clause where the interest rate shoot up, or if a condition is not met. I always explain this to customers in plain language so they know what could happen. It's also important to include those details in my note in your note to the lender. We want to make sure the loan is suitable, not just for now, but in the long term. The fifth one is borrowing to invest. So when clients borrow to invest in shares or manage fund, there's always a chance the return will not come through as planned. But the loan amount still there and they still need to pay that off. Most lenders do not use projected investment income when assessing the deal, which makes sense because the income are never guaranteed. So the clients need to have a strong income position already. I make sure to explain that in the note, and I talk to the customer about having a plan B in case the investment take time to grow. So the next point, the sixth one, is short-term and long-term risk. So loans run for long-term, which seem affordable today, but might not be the case like a few years after. Clients may go from two incomes to one, or start a family, or get closer to retirement. These changes can affect their ability to repay the loan. So this is why I always include details like age, dependence, and how long their business has been operating. It helps the lender assess the deal not just from the monthly repayment angle, but in terms of long-term stability. The last one, so why assumption should be avoided. One of the biggest things I've learned to never guess. If there's missing information or something unusual in the client's document, I always ask the client and explain it properly in the file. If we make assumption or leave our context, the credit assessor will not understand the full picture, and they are not going to call to the customer. They rely entirely on the note and the document that we give it to them. So being clear, accurate, and honest make all the difference. That's it for me today. So risk is a part of every deal, but if we take time to understand it, explain it well, and back it up with the right documentation, we can build trust with lenders and deliver a great outcomes from our customers. So thanks again for listening. I will speak to you next time.